Welcome to the Property Funder podcast. I am here today with Keith. Before we talk to Keith, I just want to give a quick thank you to Patron Capital, which is the show's sponsor. Patron Capital is a development and bridging loan business based here in London, lending between £250,000 and £25 million on projects all over England and Wales. Now, if you are a new visitor to the podcast, welcome. Where have you been? If you are not, if you're returning and you're not subscribed, could I please get you to subscribe and like and give us a 5-star rating so that more people can hear from inspiring and engaging business leaders in the world of real estate and finance, like Keith, who we've got here today. Keith, could you give us your full name and the name of your business, please?
Sure. My name is Keith Breslauer, and I am the founder and managing partner of Patron Capital.
So Patron Capital, it's a pretty well-established business. Many of our audience will have heard of it, but for someone who hasn't heard of Patron Capital, how do you describe Patron?
We are a classical private equity real estate firm. We invest in property and property-related opportunities, primarily in Western Europe. The format is a closed-end limited partnership fund structure, which we manage on behalf of about 100 or so investors. We invest the capital, we generate hopefully some profit, we return the capital and the profit, and we start again. So that's the pacing.
So for those people who haven't got a familiarity with private equity investing or funds, how many funds have you raised over how many years?
Sure. So we've been around for 25 years, but we started the fund business probably about 20-ish years ago. The structure in our format is that we have one fund traditionally, which does everything. We raise it about every 2 or 3 years, and we invested. And if we do a good job, our investors return and come back. So we are now on Fund 7. We've just had our close of Fund 7. And we had about 76% re-ups, which are existing investors who came back from Fund 6 to Fund 7. And we're averaging, I think, about 67% returning capital over 15 years. So very strong investor following. The format is in our model is one fund, a diversified strategy. And once we invest a fund, we then do it again.
So if my Bloomberg research was correct, it was about 860 million euros in the latest Fund 7?
That's correct. So the way we define Fund 7 is really a pot of capital, which is our main business, which is called the fund. And then we have a co-investment pool that we have discretion on that is used by us for larger investments and to diversify strategies or investments. So it's 660 in the fund and 200 in the co-investment pool. So collectively it's 860. We have some additional capital that is behind that, which is what we call SMA type capital, or separate managed accounts, which may or may not come in on individual deals, etc. So if I go back to years ago in Fund 4, from memory, I think we had about 800 million or so in the fund, and it ultimately grew to 1.1 billion as we did very large co-investments.
So many of our audience will be small, medium-sized developers. They go, oh, wow, 860 million euros. How are you going to deploy that? What's the typical deal look like from a patron perspective? How do you get the capital deployed?
So, in terms of characteristics, let's start with that. We say the average equity investment we make is somewhere between 30 and 90 million euros of equity. But in reality, we do a lot of programmatic investments. So we have a very good developer, a very good partner we're working with. We might deploy 30 to 40 million with that partner, but that might be to 3 or 4 investments. So you imagine you could do things between 5 and 10 million euros. So we're comfortable doing smaller deals. We define that as programs or programmatic investment. But in general, if you look at our relationships, they should be between 30 and 90 million euros of equity. Now, going to your question, if I unpack your question a bit more, if I think about how we deploy, if we say, okay, let's say half of it's going to the UK, then you can imagine that you probably have relationships with maybe 5 or 6 major operating partners that we work very closely with. We do nothing on our own. We do everything in partnerships.
Now, obviously, with something of a background in private equity real estate myself, I hope you'll forgive this slightly more basic questions, because clearly some of our audience, some of our listeners, maybe being a little bit less sophisticated, we're obviously trying to make the questions a bit more accessible for people. But just if you could just explain why you have to work with partners, why it's so important to be working with partners rather than deploying the money directly yourself and managing the investments directly yourselves.
Sure. I think real estate is very much of a local model. And I think the challenge of property and property investing is really understanding the very specific characteristics of a local market. So if you think about what is driving the macro opportunity today, it's demand and supply imbalance. It's an interest rate shock and how people are dealing with it. And it's how you're going to address the ESG requirements that are either implicit or direct. So when you think about those three macro ideas, and now you're saying, okay, is there an interesting opportunity? You really need someone local who could help guide you with respect to specific local characteristics, the demand supply of a particular building, the ESG requirements, and the ability to refurbish that building to a higher standard, the related current owners of property in that area, and where there might be an opportunity for distressed or use of our capital. So the local partner plays a very, very key role in navigating the local dynamics, both on the creation of the business plan, so how do you formulate the plan, and the implementation of the plan. So what tends to happen, of course, in all deals is things go wrong. Things change. And as things more change and they morph and they evolve, you want someone local who could help navigate that path with you. And that's why our perspective is to work very closely with local partners, either in a joint venture structure or where we invest actually into the partner itself.
So you actually invested into the platform per se. Yeah, I mean, is another way though to describe it as well. It's a sort of distributed or outsourced business model, which means that you as patron don't need to have a huge staff base, don't need to have offices in so many locations that you know to be able to manage all these things as well.
I wish that was the case. That is what we call an allocator model. Yeah. We haven't really adopted. We've tried that a long time ago. It just doesn't really work. You have to run it as effectively a hybrid model. So we have an in-house development team that is really the bricks and mortar behind the business, and they work very closely with the partners. So while we might not have hundreds of offices, what we do have is we have a localized, we have very experienced people who work very closely with the local teams to help deploy the opportunity. We call that so the two models are owner-operator, where you don't have a local partner, versus an allocator, where you're basically allocating capital. We're somewhere in the middle. We call ourselves a hybrid owner-operator model.
Yeah, so it gives you it gives you the ability to have scale, but also you're not so far away from the detail that you wouldn't be able to know what's going on or be able to step in if something went wrong.
Well, that's exactly correct. So going to your point, we've had subcontractors go bust on projects, and our local partner is very strong, didn't know how to necessarily deal with that, and our internal development team helped, as one example. And to your point on scale, effectively the model is a scaling model. So if you're obsessed or focused only on one asset in one location, you can't really quite create the scale. So you have that, hence the hybrid dynamic.
With the fund model, presumably it helps having these operator partners that you've built long-standing relationships with as the, I suppose, the investment manager, because presumably you, at the point at which you're raising the fund, you already have a good sense of what the pipeline is going to look like. Because from what I understand, what I know in the private equity world, the last thing someone who's committing, potentially 50, 100 million euros to your fund wants to do is to make that commitment, and then you never actually deploy that capital.
Sure. So what's the question? About whether I have a pipeline?
So presumably though, that it makes sense to have a good pool of partners, of operational partners, developer partners, so that you then have some degree of predictability around the flow that you're going to get.
Well, exactly. So let's break that out into terms of different components. So first, we have 90 or so partners that we work with closely. We probably have 25 active operating partners today. Of those 25 operating partners, I'm going to guess over 20 of them have been with us for 10 years or more. So that's the partnership dynamic. In terms of the flow, I would say 40% of our business comes into the operating partners. Roughly 40% we get direct, it's 80, 20% coming from brokers, advisors, et cetera. So, and of that group, we today have about $7.5 billion of equity that we have priced or reviewed in the past, call it 4 months, which has taken us a day a week. So when you break that back, we have about 600 million or 700 million of very live transactions that we're exclusive on of equity that we're working on today, and maybe a third of it closes. So about 200 million seems to be very live, going to close in the next 3 to 6 months. And if you think about our pacing, when you run an 860 million euro fund, you have a 4-year investment period, you're probably putting out between 2 and 300 million out a year. So that kind of works into the pipeline and the partners, going to your question.
Yeah. So I suppose my next question is there's a lot of discussion around fund vintages. And so from my outsider's view, it looks like it's a pretty interesting, pretty attractive time to be deploying capital. Could you just talk to our viewers and our listeners about, when I use the expression fund vintage, what does that mean, and why would you argue that now is the time to be deploying a fund, and this particular vintage will be a very strong one?
Sure. I mean, vintage. The term vintage is supposed to typically mean on when is the date that the fund is formed and investing money. It's a bit confusing because some people refer to the vintage as the final close. Typically, most of the fund structures similar to ours will have a first close, and say a year to 2 years later, we'll have a final close. So in theory, the vintage, depending on how you define it, might be the date of the final close or might be the date of the first close. So that's the first question. But it really goes back to, when is the money being deployed? So if you close, let's say today, and you have a 4-year deployment period, but you put all the money out in year 3, then the vintage isn't really 2024. It's actually probably 27. But it's recorded in terms of the comparative statistics as 2024. So the starting point, before I get to the second part of your question, which is it good vintage or not, is defining vintage is very tricky. And that's one of the reasons when you look at competitive statistics, it's not always obvious. And I would like to say that you should really look at when the manager deployed the money and compare to other managers who deployed at that same time and see how they've done. And you can really determine alpha or not. Otherwise, it gets complicated. Next, is it a good vintage or not? The answer is it definitely seems that way. We've had an interest rate shock. We had an ESG problem. We have this big issue with office buildings and what's going to happen. So it seems that there should be a significant amount of distress in the system. The challenge is, how big is that distress? And also, how many people out there hunting? So if I had to compare this environment to the past, 31 years I've been in England, the most exciting time coming to the UK was in 92, when there was only one other competitor and interest rates were north of 12% and were coming down. And there was a real opportunity to buy credit. And we did that, and we made a lot of money. The next was probably 2009, where you had this enormous amount of debt in the system that had to be worked out. And we were able to take advantage of that. And we were very large buyers in the UK at the time of distressed credit and businesses that were tied to debt. We're now in the third example of that. So this is an interesting time because you have the combination of the distress being driven by capital structures that are weak because of higher rates, but also ESG requirements, which is unusual versus the US. But on the flip side, there's not a lot of supply. So what's making this market not necessarily that cheap is when interest rates are stable and potentially coming down, it by and large gives the borrower time. It gives the lender hope. And if you put those together, it means that they're not going to sell it that cheap. So I think it's interesting, but it's tricky. And therefore, you have to find the unique opportunities that have a combination of a rate issue as well as perhaps an ESG issue.
Do you think that some of the changes post the GFC in terms of, I suppose, banking regulations means that in a lot of ways, I know obviously there's some situations going on in the US, but let's say in Europe, do you think though that has contributed actually to this kind of what I'd call the sort of buyer and seller strike, because ultimately the banks haven't lent too much money. They're not under that much. They're not that underwater, and they're more willing to extend and pretend than they would have been, and probably learning the lessons as well from 15 years ago. Sure. Do you think that feeds into it as well?
Yeah, definitely. I mean, I think, well, going through the stats of this, you have one, the banks have a lot more capital than they've had. Second is the percentage of their loan book that is commercial real estate is a lot less. Third is Europe, unlike the US, does not have a big CMBS market. So our shadow banking system is much smaller. So all those play into the differences from 08. I mean, in 08, just to put in perspective, we had NAMA, which is the Irish bad bank. We had SARB, the Spanish bad bank. In England, we had effectively Bank of Scotland, which sold everything down after the Lloyd's merger. So we don't really have that kind of story today. Most lending that we've come across is either bilateral between two parties, or it starts off as bilateral and becomes a syndicate amongst banking friends. The banks really don't have an interest in exposing their balance sheet in light of lessons learned from back in the 08 era. So the short answer is yes, I agree with you.
There have been some instances of people from the private equity world dipping their toes in the water and moving into the lending space, effectively replacing or refinancing existing facilities. I guess kind of, taking that upper slice of risk and then having a wholesale facility behind it, and achieving, I suppose, double-digit returns on a geared basis. Is that something that you're exploring as well? And sort of replacing some of the banking options that are available to people, but being at, 75p in the pound exposure-wise, or is that something that you're not that interested in? You'd rather focus on the distressed credit side of it?
So we look at everything. What you said is quite interesting. So first point, have banks retrenched and therefore are not lending high advance rates? Yes. Is that what's driving the opportunity? Not really. What's really driving the opportunity is many banks made loans at 50-55% loan to value. The values have fallen 10 or 20 points. They're now at 70%. And they're like, okay, Bar, you busted your covenant. I'm happy you're paying your loan, but take my debt down. So the mezz guys come in and they say, hey, we'll provide mezzanine at that 65 to 75% detachment point or attachment point. And they'll do it at X rate. And therefore, from a risk-adjusted basis, they're pretty good. What's interesting is it's quite a competitive market. It's not obvious that it's so dramatically cheap. So the market is more like something as cheap as low as 9 to maybe 12 or 13%. Now, what's interesting, what you said is you use the word leverage. So that's an important concept. So what a lot of credit guys are doing is they're using what they call back leverage, where they're lending these mezzanine loans and then they're leveraging that pool of loans and driving their returns. But it smells like a CLO. And therefore, there's an interesting question about, are you really de-risking the book, or are you compounding risk, or how does one look at it? I'm not sure. If you ask from our perspective, we think the mezz space is very interesting.
But ultimately, you need to be the right attachment point, the right sponsors, and effectively the right structures as well.
Yeah, I think, and also the question of the product, because many of these mezzanine loans are not simple, straightforward properties. There might be bridge lending, there might be residential construction loans, there could be office buildings, and it gets tricky on where one fits in that space, given that risk. So you have to have the ability in-house to take over that risk, to deal with the borrower, to maybe finish the project. Otherwise, I think that the lending business becomes quite scary.
Yeah, I mean, obviously, being in the lending business, we have some experience of that, but certainly, if from the outside looking in, there's a lot of people who are going into the lending space, maybe not fully understanding the risks that they're taking, or having the experience or the skill sets of the people, to really get involved in that. We have a specialist product, which we used to call Finish and Exit, now called Part Complete. And the whole purpose of that product was to step into part built developments as a lender. We were able to do that because we had an experienced team that was used to it and knew all the things that you needed to do, all the things that you needed to watch out for. Also, the things that aren't that much of a concern that would enable you actually to make the loan and not cause issues for your customer. Of course, there's no IP in finance. So as soon as we start doing it, everyone else starts doing it. But actually what you find is that a lot of people who move into the space don't actually know what they're doing, and they end up getting caught out and getting into trouble. And we've had a few situations where we've had effectively funders pick up the phone to us and say, can you please take over this loan for us and manage it for us? So we see that situation firsthand. So I think it's quite interesting but it's an interesting space, and obviously you seem pretty open-minded about the opportunity. With regards to,
well, a question you asked me, you made an interesting point about other people entering the system. I mean, the perception you have is that there's lots of private credit guys trying to pile in.
With a lot of private equity real estate guys trying to go into the credit space. Yeah.
Absolutely. And we see that for us, we see it as an opportunity, but it's not clear the size of that opportunity, and also it's not clear the type of loan. So it was interesting when you get the introduction about the range of loans that you're making. Some of the people like big programmatic lenders like Cheney or Ares or stuff are doing much bigger positions. That's a tricky business. So we'll see.
Yeah.
Very tricky. But our when I was at Lehman Brothers for many years, and did much more on the equity and principal side. When Lehman really got into the mezz business, I realized that, or I felt at the time that I didn't think we had the capacity to manage problem positions. And we shouldn't be in that business as a result. So exactly to your point, if you have that capacity and that ability, great. If you don't, buyer beware.
Yeah, well, I think that's one of the challenges that people who want to deploy capital into the lending space need to appreciate is that when a loan goes bad, you need a team. You need a team, multiple people with the right skill sets, because things can get ugly very quickly. And to the extent that you might even have to evacuate a building that's part completed, but you've already got residents living there, right? Not being funny, but if you've got a $500 million or $1 billion fund, then you think, oh well, I can just go and deploy capital into lending and it's going to be easy money. And then something like that happens. How are you and you've got 30, 50 or 100 loans. How are you going to manage that situation out with as typically the case with private equity businesses and private credit businesses? Probably not a massive headcount. You're going to need to have the specialist skill set.
And then the argument is that the individual's resources are being misallocated.
Yeah.
So we have backed platforms that are actually lenders.
Yeah.
Because we cheated essentially. So we said, okay, well, you can use our guys if there's an emergency, but in the meantime, you go about it. You got a great team, and you do what you have to do, and we'll follow up behind it.
Yeah.
So it's not obvious, but I do go back to the question: is there a real opportunity? Yes. Is it overloaded with capital? Not really. The trick is the origination side, the competitiveness side, the trust. The real estate business, frankly, all business, but the real estate business is really a trust business. You can screw someone over once, but that doesn't really work more than one or two times. And I've been doing this a long, long time. We have a very good reputation because that's something we value very highly.
Well, actually, that gives me a nice segue to a question, because a gentleman we both know who was actually randomly had a chat with today called Sanmi, who I know you know a little bit. He actually mentioned to me, you've managed to. His question for you was, how have you managed to be in the industry and be so successful and have very little bad press surrounding you? To have such a good reputation around you. What were the qualities? What are the qualities? What are the principles that you stand by, you live by, that have enabled you to have that success, but maybe not have the baggage that goes along with it?
Well, I think I have a lot of baggage. Sounds like a great concept, but I'm not angelic in any stretch of imagination. But no, I would say that in the professional world, you have to do a couple things that are really, really important. You have to do the best you can to demonstrate the highest degree of integrity. You have to be a person of your word. Very, very important. Your name and your reputation is very important in that regard. So we're not, for example, when we're involved in processes, should we be bait and switching, bid high, we bid low, things like that. I think that's just bad blood. I think what's important is you might say, hey, it's based upon these 5 assumptions, and we're very clear at the outset. And if it turns out those assumptions are not correct, or there's a problem, then we have to talk about it. But what you shouldn't be doing is misrepresenting yourself for what you can do and not do. And I think we try very hard to avoid that, and to really be straight about our businesses. That's kind of one. The second thing is, because we're very much of a European-focused fund, we don't have competing interests affecting that capital. So when a partner brings us a really interesting deal and we're working on it together and we spend a lot of time on it, I don't have to say to him, well, I'll never say to that person, by the way, we've gone to committee and the committee has decided that we're going to invest in Japan over this deal. Okay. Now that actually happens in big funds. It doesn't happen with us. So with us, we're very clear on what we do. We're very clear on what we're trying to get to. We're very open at the outset with partners, and we hope it works. It's not always perfect, but we do try to hope that it works.
Yeah, it's interesting. You mentioned about investing in Japan. A former protege of mine is working at one of the large private equity funds, and I think I had dinner with him about 2 years ago, so just after the Ukraine war, and we were talking about development finance. I think they were looking to deploy quite heavily into UK development finance, and then the Ukraine war started, and then I think they were going to roll into equities or some sort of or some sort of liquid instrument as a consequence of that. And I did think to myself, wow, I mean, whoever the programmatic partner was that they were going to do that with, they must be pulling their hair out, because they thought that they had this backing, and then all of a sudden they can't do what they were planning to do. Sure. And it's not like it's gone to a competitor. The money's gone to a completely different sector, because some committee, like you said, some investment committees decided that actually we're just going to deploy completely.
Remember the attacks on the bridge? It freaked a lot of people out. And we knew big investors who say, hey, we don't want to invest in the UK because we think it's highly unstable economic environment, what's going on, a social economic environment, et cetera. So you're right. I think it's, it's very important to walk your talk. That's the key of all. Now, it could be that you're nervous about something. It could be that actually the Ukrainian war is affecting an opportunity, but you have to say it. You have to say, this is what we're worrying about. This is how we're thinking about it. These are our 5 issues. And if you could solve them, we're good. And if you can't, we're not. And I think we've tried to reflect that over a 25-year experience at Patron, and therefore people know who we are. The other thing is we have this incredible team. I mean, this is a very important point of why it works. We have the average partner has been with Patron for 16 years. The average turnover over 25 years is under 6% in the investment team. No firm has that, right? So when an external partner calls and says, hey, let's work together, they know Christoph is a guy that could talk about Germany. They know Steven's a guy that could talk about special sets. They know Daniel's a guy that could talk about the UK. They know Tim Swift does a lot of work on the credit side with Steven. So people kind of know the deal. And if there's a problem, they could call me. But my partners do a fantastic job in terms of what they're doing, and they manage their businesses very well.
I mean, how many people are you now across all of Europe in Patron?
So we have about 60 people. I use the word about because approximately about 10 of them are sort of senior consultants, FTE types. So 50 is probably the right number. I have 52 desks in London, I can tell you that much, of which probably 30 get occupied on a regular basis. So yeah, 50, 60 people.
And I mean, if we can just talk through the genesis of Patron, how did you get started? How did it come about? Obviously you mentioned you were at Lehman. Maybe you can sort of touch on, kind of the end of your education and your career up to
Sure.
when you founded Patron.
So I had the benefit of some phenomenal bosses. So I had worked for some really good people. At Lehman Brothers, they gave me an enormous amount of freedom and opportunity. And I worked very hard for the firm for many, many years. And thank God we did very well. What happened ultimately is that I was given a great opportunity to move back to New York, which is fantastic. But I love London. I love Europe. I love working here. I love the people here. I formed very, very close friendships here. And I didn't want to go back. But I never managed third-party capital before, and I really only worked with Lehman Brothers' balance sheet. And I was given a really great opportunity with Lone Star, and I did a joint venture with Lone Star, and I learned a lot from John Graken, who is an exceptional first-class investor. And I got a far better understanding of the fund business versus being within a large investment bank. And on the back of that experience, we set Patron up, and the vision of that, or the knowledge base, was let's go raise third-party capital to do this. And the first fund was unbelievably difficult to do. It took us 2 years, and we got half of what we wanted.
So when you say us, how many of you were there in the beginning?
We had about 3 or 4 people, but expanded reasonably quickly because we started making investments first before we got into the fund business. And then we needed people, and we were able to fund that and grow. But the key anchor, let's call it, was a man by the name of Peter Lewis, who was a very good man. He passed away, unfortunately, who was at the time at MIT Endowment, and they were our anchor investor. And we had people from University of Michigan, University of North Carolina at the time, Sagita, Tom Singh, and those investors really were the core group, and along with the Church Pension Fund as well, Alan Snoddy, who really helped create Patron, and that's how we call the captive fund got started, how Fund One got started, and kind of led to the future. So it was an evolution of going from being a direct investor, but investing using a company balance sheet, to working with third-party capital in a more of a partnership perspective, to actually becoming a manager of third-party capital. And that was the original journey that we went through.
Now, as far as I understand it, it's normally expected that the manager co-invests alongside the limited partners. The general partner will co-invest alongside the limited partners. In your instance, did you have the capital available, or how did you manage that?
It's a great question. I would say in the very beginning, I had this view that I needed a very large GP commitment, using the term that we use, a general partner commitment, to raise capital.
And that's normally about 20%, isn't it?
At the time, it was between 10 and 20. Yeah. So the normal run rate's about 1% once you get going and operational. But when you're really starting out, it was 10 to 20%. And I had a very good friend of mine named Polya Zalbadovich, who really was going to seed the fund. And the theory was that he would provide. I didn't have much capital. I made some good money, thank God, but I come from a very poor family, so I had to take care of my family and my parents, etc. And I had my Lehman Brothers stock, which I still had when I went bust. But 1997, when I left Lehman, or 1998, when I really formed Patron, I had a limited amount of capital. So the theory was Mrs. Zalbadovich would be a co-investor. He would have a stake in the GP. He'd provide that anchor capital along with whatever I had. And that was how it started. What actually happened pretty quickly is that when we started talking to large investors, they're like, listen, we like Mrs. Zalbadovich, but he's not your investor. He's not investing, and therefore we're not really backing him. So the fact that he's putting up a whole bunch of GP money doesn't mean a lot to us. It's nice, but it doesn't mean a lot to us. What we'd rather do is you put up the capital, and Mrs. Zalbadovich could be a passive investor. So Polya was a good friend, ended up becoming, although he invested us early on in some direct investments, he became a very small investor in the first fund, and we had to put up much more money. So I think we put up in the end about 5% of that fund from memory. Where did that money come from? Well, I had a mortgage on my house. I had to do a bunch of different things, but effectively we got the capital together and we put the money in, and thank God it worked. Yeah,
it worked out. Obviously, the rest is sort of history.
Yeah.
So if you remind everyone, so it was late 90s, early noughties when the first fund was launched. So then presumably...
I would say technically it was 2001.
2001.
So I think 2001 was the first fund. Then we did fund 1, 2, 3, et cetera, but every couple of years.
Obviously, you had, the late noughties, obviously the GFC kicked in. How did your funds fare during the investments that you made sort of pre-GFC, and then that you were then holding when, I suppose, Lehman Brothers went down? How did they perform? And I suppose more importantly, what were the lessons that you learned and drew from the ones that didn't perform as well as you would have hoped?
So a little bit of the actual performance, and then we get into lessons learned. So our very first pool of capital, we called the captive fund, was a phenomenal home run. We made north of a 70% return. We did extremely well. Fund 1 was a significant home run, and it took us 2 years to raise it. I said, and raise half the money. We went to raise Fund 2. It took us about a little bit more than 6 months or so to raise. We got what we want, a little bit more than what we wanted, and we closed the fund. We invested half the money. The first half did exceptionally well. We started running out of capital, and then went to raise Fund 3, and we got triple the money we wanted. Actually, triple the money. So we went from a 300 million euro business to €1 billion, effectively in a year. And then we had, and then the crisis hit about halfway through the deployment of that capital. And then of course, after that we had Fund 4, et cetera. So how we actually did is that the first half of Fund 2 did extremely well, including making some investments in Central and Eastern Europe. when we continued making those investments, including zoning, investments that needed zoning and had ground up development, but a lot of zoning risk and timing risk, et cetera. Those investments are crap. They did very, very poorly. They got extended by a dramatic amount of times. And that impacted, of course, the early stage of Fund 3. So when the Bear Stearns bonds got re-rated in 2007, we already smelled something going wrong. So we tried to stop. We preserved half the capital. So therefore, whatever crap we did in beginning of Fund 3 that didn't work out ended up working out very well in the back end of Fund 3. So the punchline of all this is that we ended up bringing our investors' capital back, less expenses on Fund 2 and Fund 3, which is much better than a lot of our peers. The negative is that I can't bifurcate the middle of Fund 3 and say, hey, I've only look how well I did, because I think from memory we made it north of a 20, maybe a 28% return. I forgot exactly the numbers on the second half of Fund 3, which paid for the early part of Fund 3. So investors appreciate what we did. They thought we did it. We respected we had a high fiduciary respect of capital, and therefore we raised $1 billion for Fund 4, and we did very well. We continue on. What were the lessons learned? So the first, what saved us versus, say, the big investment banks with big funds at the time, is that our average debt at the time was sub 40%. Our average leverage across our book is about 53%. Why? Well, that's not a lesson learned from the GFC. It's a lesson learned from growing up in a distressed space. And my dad was a developer who always borrowed too much money, and things always went wrong. So we learned the lesson of not borrowing a lot of money. So that's what saved us. What went wrong is that I underestimated duration risk attached to zoning related deals. The spreadsheet looked amazing. You could deploy a lot of capital, but the reality was that things took. We have an investment that took 12 years, and it's supposed to be 3. Just to give you a flavor. Now we end up doing okay on it theoretically, but in terms of actual return for risk, terrible investment. So that was a key lesson learned, I think, and we said officially, well, we're not going to go back to Central and Eastern Europe. And we're not going to do zoning related deals, but there's always lessons you're learning through this process.
It's funny you mentioned the zoning for UK audience planning, but it's kind of.
Okay, I'll give you a UK deal. We own a piece of land in Berkhamsted, right, which is Decorum Council. It's a phenomenal piece of land. It sits between Berkhamsted and the A41. There's no reason why it should be greenbelt land. They are substantially below their numbers in terms of required housing for the community. I think we're in year 15, right? I mean, there are very few places in the world where farmland is worth £10,000 an acre or so, and residential land is worth £2.5 million an acre. I mean, that's just a good example of how screwed up the system is. So it's a very, very tricky business, and I think it's interesting, but it's only for certain types of investors.
So just as an anecdote, the private equity fund that I was working for many moons ago, they bought a site in central London, 2006. So great timing. Had to go through planning. The mayoral sill was based at, we ended up becoming the benchmark for mayoral sill, that particular deal. It was finally financed, built, leased and exited 2015. So 9-year journey, for a private equity fund that would have underwritten that as a 2.5, 3 year hold.
I mean, so that relates to an interesting question then. Is the fund model a good model? Right? The fund model assumes every 4 to 5 years you're bringing money back. In fact, we typically underwrite about a 48-month period, right? So COVID blew us out about a year and a half, so that impacted returns. But is that a good model, right? So the large fund manager, which I won't mention the name, but has a letter B in the beginning.
I was actually going to ask you about that, but okay.
has a pool of capital that they call, I forgot what the term is, but it's much more longer dated. And therefore, in theory, they could make those long dated investments, and they could be very interesting and very powerful. I think you lose a bit of discipline in that because, projecting out more than 2 or 3 years generally is already almost impossible. But there you go.
Yeah, I suppose that sort of evergreen, more patient capital. Yeah, if you can do it, if you can deploy it, it's obviously advantageous to have that degree of patience, available to you. But I think it's an interesting point that you make around discipline, because if you to your point, if you don't have that pressure to deploy, you can always kind of go manana about the things that you need to do. The things that you should do today, you can push to tomorrow, and before you know it, 10, 15 years have elapsed and you haven't really driven that particular investment forward.
Well, I mean, the argument that people say is that you find a really interesting opportunity, you create a great product, and therefore you've created all the value, and now it's just a great running yield. Why force to sell it if it's such a good asset? But that's not what investors give us money for. I mean, that's what an insurance company might want, to liability match. But they're not giving us money to liability match. They're giving us money to make money. That's what they want. And if we can't make them money, what's the point of it all?
I hear you talking about returns in percentage terms. So that's presumably your IRR. Where I was working, money multiple was also quite important, but I haven't really heard you talking about money multiple. Why? Is that deliberate? Is there a particular reason why you're more focused on IRR than money multiple?
Not really. I think that you need to have both as a metric. I think the industry, at least many of our investors, focus on IRR because their bonuses are paid on how well their return beats their related index. So they care much less about money multiple. And you would assume that a manager who's trying to make a promote likes money multiple because they're trying to make a higher share of the quantum of profits. I don't know. I think I've been in this long enough. I think IRR remains a dominant dynamic, and equity multiple is, at least from an investor perspective, is less important. They remember that when they commit capital to us, they're essentially going into an illiquid fund, and therefore they're not. They have to think about, are they getting compensated for the liquidity, the lack of liquidity, and that's not obvious, right? So that's a tricky part. So going to your point, I think the IRR is much more sensitive to the average investor because it relates to being able to turn it or churn it, while the duration is interesting. But for a high net worth family, it's perfect, but for an institution, less interesting.
For institutions, it's different. That's right. Okay. And just talking about fund size, because, and this goes back to the big private equity fund, Nate, with the first letter B, they're raising funds, either European or global funds, not into the hundreds of millions, but into the billions. Tens of billions at times. Presumably, with your reputation, you probably could raise much larger funds than you do. Is it deliberate why you choose the fund sizes that you do, and why have you chosen, let's say, 860 million euros in this iteration of the fund when you could have gone for a bigger raise? So
the challenge is understanding the competitive landscape. So if you argue that there's about 4 or 5 managers out there that have 5 billion plus type funds, those are the ones competing with the direct deals. I wouldn't call it an oligopoly, but there's a group of people who compete, and your dead deal cost ticket to do a large deal could be 2 to 10 million euros of equity.
Yeah.
So that would wipe us out, right? So our ability to compete in that space doesn't really make sense unless we could really raise that kind of money. And even then, it's not obvious it makes a lot of money, but that's a different discussion. So we're very much focused on smaller opportunities, generally, and we get brought into bigger opportunities by other peers. So, for example, we're looking at a deal now that was supposed to be 400 million pounds of equity. It's actually 700 million of equity. We can only fund 100 to 200 of it, but we have a lot of friends who want to put capital in, and we'll see. So the answer is, the mistake I made in the past, as I hopefully illustrate a little bit, is we went from a 300 million euro fund to $1 billion in a year. I mean, it's a disaster, man, because that frames everything the wrong way, and you start thinking about deploying capital, and all of a sudden everything looks great. And that's why ground up development looks really exciting, because you can use a lot of money and can make a lot of money. But if reality is very different than the spreadsheet, it's a stupid idea. So going back to sizing, we could handle a pool of capital that's about $1.5 billion, maybe even more. But we choose this capital because what's the downside? We raise the money, we invest it, we go back out, and we raise it again. The only guy who really suffers is me and the investor team, who have to go out on the market a lot. Next, is it too presumptuous to assume, given my reputation, we could raise a lot of money? I think that's a big, giant assumption. I did 760 meetings and Zoom calls, me and one of my colleagues, partner Shane, over a 14-month period. We landed, of that, say, 500 or so were new investors. Of the 500 new investors, we landed 15. It's brutal. That's what it is, but that's what it takes. So in order to raise big capital, you need to have large capital pools that will back you in your strategy where you have discretion. That means you have to have the U.S. state pension plans. You have to have the Dutch pension plans. They are prepared to give you money, but you have to be a much bigger fund. So it becomes a bit of a circular logic. You want 200 million from a guy? Well, you have to be a €2 billion fund because he doesn't want to be less than 10% of the fund. So we never embarked on a strategy of going big, mainly because it's a different type of capital and it's a different type of strategy in terms of how you deploy. Can we do it? Yeah, we can, but it's just something that we chose not to. And despite I just moaned about being on the road, I like actually dealing with my existing investors. They're great relationships. We speak to them all the time. I'm happy to see them. I see probably every 4 or 5 months we're seeing everyone.
And just also thinking about the large, the sort of mega funds as well. The types of deals that they're having to do. They're having to buy large existing companies. I mean, a friend of mine who's the managing director, CEO of an industrial investment business that was bought by the gentleman and ladies named B last year for £300 million or something like that. Fundamentally, there is a limit to the number of deals that are out there, and when a big deal comes along, presumably you then, because there's not that many of them, there's a scarcity of them. But is it theoretically possible also then that your underwriting principles can go out the window because you get a little bit overexcited to try and
to beat them?
To get the deal.
To win the deal. Sure, it's very possible. It's also one of the reasons why I'm not a big fan of large segmented funds. So if someone said, "Hey, why don't you raise $1 billion for residential, and the rest will do something else," it's just not what I want to do, because I think that when you raise a very targeted strategy fund and you raise too much money, then the risk you run is, going to your point, is you start to cheat on the underwrite to make the deal work. And that's a very natural dynamic, and it's very hard to avoid it.
Speaking of residential, Patron was involved with Carla Homes for some time. What's the status of Carla? Are you still involved with Carla, and how what's your reflections on Carla as an investment?
Carla was a what they call a premium house builder. When we acquired it, it was really within the army of Lloyd's Bank, and they're part of disposing their legacy stuff. We effectively backed management to do it. We ended up, it was a bit too big for us because we knew we were going to grow quickly. So we brought Legal & General in as a partner, as well as the team that's now what they call Epirus. Originally was Electro, and a few other small investors. And we bought the thing, and it was a fantastic opportunity. The business grew quite dramatically. We actually bought Banner Homes, I think, in year 3 or 4. And then when year 5 rolled around, as we're a fund, it was time to get out. And Legal & General's like, "We love this business. We don't want to exit. We really want we want you to stay." And I'm like, "I can. We have a fund." So they bought it off of us at market value, our stake, and they've continued to own it ever since. So they own Carla today, and it may or may not be for sale, may or may not come back, but that gives you a perspective.
Yeah, I think there was some discussion around listing the business at some point. Was that meant to be during your ownership as well, or was that something that's been a bit more subsequent?
That's, I think, confidential, but I don't know if you know that, but yeah, I have a comment on that. So
we can edit that out.
No, it's all fine. It's fine. So the assumption was, what do you do at the end of 5 years? And when you have a business that's £1 billion business in house building, who's the buyer?
Yeah.
And the answer is there are very few platforms that are prepared to pay platform value. However, the retail market or the institutional market will pay for value if you could generate the right returns that they want. So our working assumption is we would go public with it at the end of that 5-year period. And Legal & General was concerned. They did not, one of the problems of going public is that you don't have a really clean exit. You have to keep a bunch of shares. You might have a 2-year lockup. And they were uncomfortable with that, and they preferred not to do that.
Yeah, fair enough. That makes sense. In terms of listing businesses, it seems that the IPO markets on both sides of the Atlantic are certainly not good places to be. Presumably listing a platform that you might be invested in probably looks increasingly unattractive as an exit proposition compared to maybe what it would have been 10, 15, 20 years ago.
Yeah. I mean, we have never underwritten an investment to do an IPO exit. Anyway, is it worse now than it's been in the past? Sure. Yeah. I mean, you got companies trading at huge discounts. Of course it is. And you have to really generate growth. And real estate's really not a growth business. It's a dividend business. It's a return on equity business. So house building is potentially a growth business, but that's constrained by third parties being politicians. So I would say, are we looking at deals to go public in the future? No. Are we looking at reverse? Are we looking at public companies to try to take a stake or try to buy the assets for sure?
Yeah, that would make more. That would definitely make more sense. With your experience of Carla, do you think that the house building sector is somewhere you would go back into, in the future, or something you're looking at the moment?
I think it's fair to say that any companies trading at a major discount are prime targets for us.
Yeah. Okay.
So house building is in that group. The retail closed-end funds are in that group. Many public companies are in that group. The tricky bit on the public vehicles is there a control premium? How big is that premium? Does it wipe out the discount? Can you really make money on it as you turn the company private? Can you actually grow the platform to have value? These are all tricky questions.
Or is it even, or could you even look at it, the discount that you're buying it for, basically liquidating the assets could generate you the return as well. So,
well, exactly. I mean, that's certainly not obvious.
Yeah.
And in all portfolios, there's always a bunch of crap somewhere. They got to go figure out what's going on and what's that worth, right? Yeah. So, that's always tricky.
In terms of the sectors that we obviously talked about credit, distressed credit in particular. Are there any particular sectors, like using examples you talked about, offices and your ESG requirements, maybe industrial? Are there any particular themes outside of maybe the credit space that you really want to be pursuing in Fund 7?
Yeah, I would say, first of all, to be clear, I would say our pursuit of credit opportunities generally ends up being equity.
Yeah.
Because the lender figures out very quickly that we offer better price having the asset than buying a loan. And they have, in Europe particularly, they have relationships with the lenders, the borrowers, so they're able to make that happen.
Yeah.
So we end up effectively starting as credit distress, but we're actually buying equity.
Yeah.
Now, are there any particular themes that are interesting? Yeah. I mean, I think the ESG thing is an important point. I think the interest rate shock is a very important point. I think supply and demand is very important. But going back to your question, slightly answering it slightly differently, we're a big believer investing in the mass market, not in the prime. So I think what some student housing developers are doing with these mega prime properties where they're charging high fees, that's not for us. What we have done is buy into existing student housing, refurbish them into a high standard, but keep them at 40% below prime, and therefore we can rent the space very quickly.
Just really funny because, giving Avamore another plug, Avamore recently took a dip into the PBSA market, and we and our funders, we are funding refurbishments and not ground up PBSA. And I think one of the logical parts of that is making sure that it remains the accessible part of the PBSA market, not chasing after the $250 or £300 a week, fancy new build accommodation.
Exactly. So we found that we should be talking about. Do we actually talk to you guys?
We'll talk after. Yeah.
So I think the challenge is, I think if you take a step back and you analyze that strategy, you have greater scale, you have more certainty, but you make less margin. If you do the super high end stuff, you make much greater margin, you have smaller scale, and you have a lot more uncertainty.
Yeah.
So it's certainly not obvious. We happen to like the mass market. It's just easier, but it's more risk. It's a more comfortable risk position that we want.
Well, thanks for sharing that. And then one thing I did want to ask you about was your wish fund. Do you want to just tell people what that is? We, being as many of our listeners and viewers know, I'm very proud of my involvement in the Props Awards, and Wish Fund won a sustainability award last year. But if you want to just tell people about that, because I think it's a really great thing, and I'd love for our audience to hear more about it.
Sure. So first of all, thank you for the award. I would argue it's well deserved, but we'll get to that. So the backstory is Big Society Capital, which is a phenomenal organization, came to us and said, we got a problem. They put a white paper together, and I forgot the exact amount, but they came up with this incredible need of capital to provide permanent housing for women suffering domestic abuse. And they said, we need your help. You're a resi guy. You know what you're doing. You're in the market. How do you help? Plus, I devote 10 hours a week to charity, and I do a lot for the country, and this is something you're passionate about. So I said, well, I'm interested, but I don't want to look at like another charity. I'm not interested in providing more charitable need. I'm tapped out of capital. If we're going to do this, we have to make it a investable product. So we spent a lot of time. We ended up teaming up with Resonance, because Resonance was managing at the time the homeless housing for homeless in St. Mungo's. And I said, okay, we'll work with them. They'll be like more of a local fund, and we'll help design it. And I'll put up personally, I'll pay for all the expenses and to put together, and I'll put £1 million into it as well. And we had this idea to raise 100 million euros or 100 million pounds of equity to deploy in housing. And what the model was essentially is that we would team up with existing domestic abuse charities. These are charities who look after women who are suffering domestic abuse, and say, why don't we work together to find permanent housing for your clients? And you will then sign a lease contract with us for 10 years and manage those clients. So we will not be dealing with the clients. We'll be dealing with the master charity, let's say, and they will deal with it. But interestingly, unlike other models, we're going to only do investments or only do properties that you like before we buy them. And that's what we focused. So we focused on women suffering domestic abuse and ex-offenders. We ended up only raising £30 million, which was, I thought, a great success. But the question is, well, why do we raise more? And the answer might be that people, I don't know, they talk a big game about impact, but they didn't really care. Not clear. But our presentation was, we would buy properties at current market rents. We would make a 3.5% to 4.5% current cash. We'd have post refurbishment. We would look to grow to 5% to 6% and sell it back down and individually at the end of the 10 years. So that's where we are. So we raised a £30 million fund. We've deployed, I think, from memory, about 22 of it so far. We got the whole thing allocated. We've done it across 5 or 6 charitable groups, of course, England and now in Scotland. And therefore, we're continuing to try to refine and make it better. So it's an investable product. It should make, hopefully, a total return of north of 6. Fees are relatively low, and it's been a great start.
It sounds fantastic. Do you have a sense of the number of women or families that you've benefited in, or you will benefit from that?
I think from memory, there's 133 families or groups, let's say, that are targeted to be helped, given the capital we've raised. I think we're at 90 actually deployed right now, and the rest are coming behind it.
That's great.
So it's one other thing which is interesting. Also, we came up with this other idea, which is, first of all, Patron do pro bono. So we make very little money. I think we get paid like some tiny money for it, but we do get half the carry, and the carry is only payable if the metrics of impact have been met, not just return, but have the people been happy. Are they near their schools? How the family stay together? There's all kinds of interesting metrics on interesting questions that we ask to form the metrics. So I am a massive fan of what we've done. I'm very happy about it, and it's kind of why I go to work every day.
It sounds like a really, really worthwhile venture, and I'm understandably why you should feel very, very proud of it. You definitely deservedly won that award. Obviously, you're someone who does a lot for charitable causes, and I believe you're doing a rather large cross-channel event fairly soon. I've seen on your LinkedIn some training footage of that. Do you want to tell people what you're doing and who you're doing it for?
Sure. So I've been involved with the Royal Marines charity for, I think, north of 12, 14 years. A little bit less. Let's call it north of 10 years. Anyway, and it's been a phenomenal journey. Why the Royal Marines charity and why the Royal Marines? I think they're one of the, first of all, I think we should respect those who serve the country. And I think that's extremely important. They defend our freedom. They defend our way of life. Unfortunately, the Royal Marines are at what they call at the spearhead of services, and they tend to have a much higher injury rate than other services as a percentage of the force. And the charity has been effectively a phenomenal organization for the veterans and for serving and for families looking after their challenges and helping them. And I've been a trustee for 9 years and the vice patron of the charity. It's just a phenomenal organization. I've seen the value it creates. I cannot recommend it highly enough. So I'm a big believer in saying thank you to veterans, and I've been particularly close to the Royal Marines. Now, what's also interesting is that about every 4 or 5 years, they come up with some crazy adventure that someone wants to do, and they say, hey, would you like to come along? So 10 years ago, there was this idea to honor the 350th anniversary of the British Royal Marines. It's called the 1664 Challenge, and all the members of the Corps were involved in different ways, and they basically covered Europe. And the idea was many areas where they thought they were going to be. And there was a bike ride in France, and there was a running and marathons, etc. And the head of the event at the time called me up. His name was Gary Green, a phenomenal person. And he said, hey, I got this great idea, and we need a bit of sponsorship. Can you help? I said, sure. I said, I'm happy to help because I think the charity is fantastic. But I would like to do one of the sporting events. And I looked through the list of what they do. I knew how to run. I knew how to bike. I don't know how to kayak. Let me do the kayaking. And the original plan was to kayak across the narrow part of the channel, which is 22 miles, from effectively across from Calais, because it was coming in from France, from Calais up to Dover. Anyway, about a certain amount of time passed, Gary called me up and said, hey, I'm really sorry, but we're not going to be able to do the kayak because the French won't allow us to leave the shores of Calais with kayaks. They have to start 5 kilometers off the beach. And I said, well, that doesn't make a lot of sense. And I looked at the map and I'm like, well, what about this way? And that way was the reverse to the D-Day landing. I said, why don't we go from Port-au-Besson, which is where the Royal Marines conquered for D-Day, and go back to Portsmouth. And he said, well, that's 85 nautical miles. I'm like, I don't know, you're the Royal Marines, man. We can do this. Let's go do it, right? So that was sort of a consensual effort to do it. And I joined a group of people who were serving in veterans. And I think I was the only pure civilian at the time. And we did this row, and it was completely nuts. And we kayaked with a couple landing craft, and we made it across. It was a phenomenal adventure, and that was 10 years ago. So that was one of and I did a few more crazy adventures with them and some stuff in parallel with them. And it was great. Anyway, about 5 weeks ago, a little bit more than that maybe, one of those people who was on the paddle with me, who runs a thing called the Royal Marines Paddle Group, named Lee Waters, who's a phenomenal guy, and a guy named Joe Maynard, also a fantastic person, who were both in the Hassler Company. They were both gone through an extraordinary amount of physical and mental trauma fighting in combat. So I was very close to them, and they're great people. And he said, hey, I remember it was on a Sunday, he goes, hey, we're thinking about doing the paddle for D-Day, for the anniversary of D-Day. I said, what are you talking about? He goes, well, it's the 80th anniversary of D-Day, first week of June. And we'd like to join us. I said, what are we doing? He goes, we're going to do the paddle again. I said, which way? He goes, well, we're going to go this time from England back to France. So I said, well, I don't know, man. I've been through a couple of injuries since then. I'm 10 years older, I'm almost 60, and I don't know whether I can handle it. And he's like, well, why don't you think about it and let us know? Now, I happen to have a kayak machine at home, which is a kind of an unusual device. And so I got on it that night, and I did an hour row. And I'm like, okay, my spine works, even though it's made of titanium, and my pelvis works. So, hey, I'm in. Well, first I asked the wife. So I asked my wife, she was like, okay, I'll let you do it. Her exact quote was, I'm not really worried about the 90 to 100 miles that this thing's going to be, and because you're doing it in one shot. I'm much more worried about, or much more bothered by the training going in and all the dinners you're going to tell me you can't come on and all this other stuff. So I said, don't worry, honey, it'll be a good balance. So bottom line is we're going to go on June 3rd. It's going to be 3rd to the 4th, and we're going to paddle across the ocean, across the wide part of the channel, which is I think it's 85 nautical miles straight, and then plus currents and all that. And we hope to beach on the 4th, and then on the 5th is going to be the 4-7 Commando unit, which were the original people participating. They're going to do a recreation or an honor of D-Day. And I think there are 25 surviving members of D-Day in England in the armed forces. Wow. So we're going to take a few of them across, and we'll see how it goes. So that's a very long-winded explanation for saying in 3 or 4 weeks, we'll hopefully be making it across the paddle.
All right. And we'll make sure we have a link in the show notes for anyone who wants to make a donation.
Yeah. So I've agreed to match fund. So there's a bunch of Royal Marines raising money for this. I will match fund whatever they raise. So there is a link to it. And if you can, that'd be great. And we raised a bit of money already, which is fantastic.
Oh, it's an amazing cause. It's a great cause. And I guess, as we sort of start to wind down, obviously you've got, you talked about that charitable endeavor. What are the other things that you do outside of work that sort of keep you on the straight and narrow?
Well, so I had a father who passed away very young. I think he was 67, 68 years old when he died. And my mother had very severe diabetes, which led to dementia, and she's got very bad dementia. So I grew up with this sort of fear, let's say, that genetically I'm screwed. Right? So I have to do everything in my power to stay in shape and hopefully not have my father went through what my mom. So in that regard, I love the outdoors, and therefore I love climbing, and I love skiing, and I love mountaineering, and that's become part of our culture. So and I'm not, I would say I'm an intermediate level climber in terms of my skill set, and therefore I'm constantly trying to work on that to do it. And at least at Great Adventures, and my children are now do it with me as well. So that's all kind of interesting. So I would say outside of the charitable stuff that I do, which takes up quite a lot of time, it's really trying to stay fit and focused. And of course, it all is a positive circle. So if you do a good job, if you stay fit and your brain is clear, you're able to think properly about what's going on, and therefore the stress has less of an effect on you. If you do the charity work, you make a positive difference. Yeah, positive difference is incredibly rewarding emotionally and mentally as well. And that also helps you. And hopefully all this comes together and makes you a better professional as well. And I think all of this points to not just talking about it, but doing it. Too many people tell about impact and what they're going to do as opposed to doing it. And I think that's one of the reasons why Patron as an organization is such a strong team. We have a great team of people because everybody buys into what we're trying to achieve. We are here to make a difference in the world. And I take it very, very seriously. And that's what we try to do. And if we could achieve at least some of our objectives, I think we've gone a long way.
It sounds good. And obviously, keeping fit is something obviously many of our audience know that's very important to me. So I fully respect that. Last couple of questions, but you obviously had a relatively long storied career so far. Who would you say has provided you with the biggest influence and mentorship? You've mentioned your father a couple of times already, but are there any individuals that you look back on as being quite figurative in your in your career journey, and without whom things might have turned out differently?
Well, I think about every couple of years I've had the benefit of a few individuals who have been immensely influential, and I've learned a hell of a lot. So I had a phenomenal high school teacher that was huge in my training and learning and knowledge. I worked in campus special children, and I worked the person who was there for 2 summers. He, again, a massive positive. When I went to Chicago Business School, I had an individual that was feuding people like Professor Aliber, who I have enormous amount of respect for now in his early 90s, and I still fly him out every quarter to talk about macroeconomics. He was a very interesting person in terms of knowledge. But when I started my job, I had a phenomenal boss, John Hopkins, who was a amazing boss. He gave me a lot of flexibility and great guidance. I had Harvey Kruger, who unfortunately has passed away, who was an unbelievable mentor in terms of the concept of giving back and charity. So along that journey, I've tried to learn from different people. And now, in many respects, sometimes some of our investors have an incredibly interesting, and you learn from their perspective, and really have helped me and develop that involvement. I would say in the past couple of years, one of the challenges that when you become a bit more senior and everyone's always looking to you for advice, you have to constantly search out those people, and it's not always obvious. So, for example, we have one of our biggest investors, the CIO and the head of alternatives. I'm close to, and they've given me some very, very good perspectives and good flavors. So I would say across my investor base, they form a mentorship base, which really helped me think about the business and think how we're doing. And on a personal basis, there's a guy named, a person named Lord Rabbi Sachs, who was quite an amazing person in terms of his perspective on life. And again, that was phenomenally influential. So I don't think you run out of mentors, or there's actually one mentor per se, but actually along the journey, there are different people in that pathway. One of the reasons, like from a sports perspective, why do I like climbing? Because I'm still learning, right? So my coach might teach me something which is very important at climbing, which may not be obvious to you about work, but for example, not allowing stress to create a negative circle or a negative spiral, which ultimately leads to poor technique, which ultimately leads to more exhaustion, and therefore leads to more stress, and therefore leads to failure. Well, that's applicable to the business world, and understanding that and how do you manage stress becomes very, very important, or how to have context becomes very important. So I think I try to put myself in situations where I'm learning all the time. This podcast is a great example. I've done lots of podcasts. Why was this important to me? Because talking about it in the context of just raising a fund is very important to reestablish perspective on opportunity, reestablish perspective on where we're going with the fund and what we're trying to do. You come to our office, you don't see fancy art. You see pictures of all the schools that we built. You see a guy's leg who gave us his prosthetic leg who rode across the Atlantic. You see the boat that I took 10 years ago hanging from the ceiling. Why is that? It's because to drive the concept of humility, to remember to be humble in this process, because we have really massive responsibility to our capital, and they give us a great deal of power, frankly, and discretion. And where our job is not to screw it up, and to remember that ultimately our client is that school teacher, or the priest who has their pension plan money with us, or the lower middle class professional who's put money with a particular corporate, or an employee of Johnson & Johnson, for example, who's one of our investors, who has a small part of their pension plan with us. That's actually who ultimately our client is. And as long as we remember that, and going back to mentorship, it reframes their perspective on investing money. And I think that's a very important point in terms of how at least we think about managing capital. So I got a little carried away there.
No, I love
give you a flavor.
And actually you give me a really good segue to our last question, which is something that we usually ask, which is, if you were to give some self-talk to your younger self, let's say maybe, your late teens, for example, what would you say to yourself, and why?
What's interesting related to that question, and not to not answer the question, but what I have imagined going back to late teens, at 17 years old, that I would end up living 30 years in Europe and having 4 British kids. I'm a hardcore New Yorker at birth. What I imagined that I would only go back to New York 8 or 9 days in a given year and spend most of my time in Europe working or traveling. No idea. What worked for me, and I could have done more of it, going back to lessons learned, and what I tell younger people, is it is extremely important to expose yourself to opportunity. You will not figure shit out living in your bedroom on a computer. It just doesn't work. You won't figure stuff out in property or anything sitting behind a desk. You got to get out and be in the field. You got to be out and walk. You got to go out and experience life, because you just never know. I came to England. It started when Harvey Kruger came to me and said, as a first-year associate, along with 20 other people, I want to change the face of the Israeli capital market. And we need to help Israeli companies go public and raise money. and they couldn't do it because there was what they called the Dead Sea discount because of the boycotts. And I went back to my boss and I said, can I do this? I was working in real estate, financial services. He said, yeah, don't take on too much, but you could do it. Do 1 or 2 projects. And I worked on this deal. I worked on Teva Pharmaceutical buying a generic drug company called Lemon, and Lehman Brothers provided the secondary capital, raised money for them to do it. Lehman Brothers that year did 14 plus transactions, made a fortune of money for the firm and for the capital. And they opened up a Tel Aviv office, and all the rest of the firm followed. Okay? I went back to my normal job. 5 years later, Robert Maxwell dies. Maxwell was the largest stockholder in Teva and Cytex and a few other companies. Lehman Brothers, turns out, lent the money to Robert Maxwell for Teva, as secured by Teva. So Dick Fold asked me to go to London to go get the money back. Why me? Because I knew Teva, because I worked on it 5 years earlier, and I happen to be now the distressed guy. And that's how I get to London. I look around London, I see this huge distressed market, go back to my lovely fiance, go, hey, let's move. So it all starts out, it's not serendipitous. Serendipity is a nice way of describing it. In reality, is you put yourself in these environments and you just have no idea how things turn. So my advice to my younger self would would not be to say stay positive. I was always positive, but continue to explore. I could have done more. I could have seen more things. I didn't have any money at the time, so that of course was a constraint. But that would be my advice to others. That's very, very important to not be afraid. You know, I always give this great speech that there's no such thing as obstacles, or only challenges. There's challenges you can overcome, right? So you can't be afraid of the world. There's just it's an amazing, despite all the negativity that exists in the world today, some amazingly great stories out there. And it's focusing on the positive, I think, is very, very important, which is what I try to do.
Well, I think on that wonderful note, I want to say thank you, Keith, for joining us. That was a great bit of advice. Been fascinating to spend some time in your company, getting to know you a little bit better. For our audience, if they'd like to get a hold of you in some way, what's the best way of someone reaching out?
So in fairness, it's email, right? So I know it sounds ridiculous, but it's the best way to organize meetings and to get the whole system working. And my email, for what it's worth, is keith@patroncapital.com. And it's on the website, so you can check it out. Don't send me WhatsApp messages. Don't call me. Don't send me texts. I get hundreds of them. I don't know who anyone is anymore. I get the AI spams. So the email is a lot easier to kind of navigate, and I could easily help set up meetings and coffees, etc.
All right. Well,
and it's also important because we have people come to us and say, hey, I like life sciences, or I like certain classes. And so I would like to bring the right partners and Patron involved. We're a team. The team is very effective. It's effective because I bring the right people to the right audience.
Well, to our audience, to our listeners and viewers, thank you, Keith. And obviously you can reach out to Keith at any time. And if you want to reach out to me, I'm at property_fundo across the various social media platforms. Or if you prefer to block me, you can also choose to block me on those handles as well. But thank you very much, Keith. Thank you to our audience, and we'll talk to you again next time. Thank you. That's been great.